Welcome to Module 8 of the 12-hour MBA in Mining Company Valuations. And in this module, we're going to have a look at the valuation of a mineral project. And specifically, we're going to have a look at the intrinsic value of a mineral project using earnings and cash flow-based valuation methodology. So let's have a look at the practical example that we're going to be working through now. And it's Banro Corporation in the Democratic Republic of Congo. In the Democratic Republic of Congo, it's an example that we used in Module 7 briefly. Banro discovered an entire gold belt between Twangiza and Namoya, just below Lake Kivu. Fortress Investments at the time was having a look at a potential acquisition of Banro and to delist it from its dual listing on the Toronto Stock Exchange and the Amex through a leveraged buyout. And the strategy was as follows. Phase 1 would be to obtain a 19.9% equity stake in the holding company, that's the listed entity, through a new issue, which would have been sanctioned by the existing shareholders. Why 19.9%? Because if you take a block immediately of 20%, then you have to make an announcement to all the shareholders what your intentions are. So to start off with, and a leveraged buyout over a number of years, remember, is the objective. So we start off with that 19.9% equity stake, and then a 50% direct stake in the operating units in the DRC directly. That would have been phase 1. In phase 2 then, the stock exchange allows you to do a share creep of up to 3% a year until you reach 25%, and then you need to make that your intentions known to all the shareholders. So that's how, over a period of time, if Fortress Investments would have got to a stage of 25% and then just taken out the rest of the shares, delisted the entity, and it would have achieved its leverage buyout and owned that whole gold belt, a private equity transaction. So here's the opportunity that Fortress saw. The ability to get controlling interest in an entire gold belt, where more than 80% of the concession area was as yet unexplored. Getting in at the very bottom of the share price. In our earlier module, you'll see that the resources in the ground were so undervalued with its peers that you can imagine that once they get into production, that there will be a re-rating of that share price. So that was seen as one of the serious benefits. Banro Corporation at that point in time had $180 million in the bank because they had just done a rights issue, and they had sufficient funds on hand in order to fund the full development of the first mine, and that would be a 100,000 ounce a year mine at Twangiza 1. There would be, in total, at least 5 mines producing a minimum of 100,000 ounces of gold a year. Banro had negotiated a 10-year tax holiday from the start of production of each concession, and there were 4 different concessions. There was attributable free cash flow of $3.4 billion over 18 years. Banro had one of the best management teams, and ongoing investment could be funded from free cash flows over the vesting period. So that was the opportunity available to Fortress Investments. So let's see how they went about doing their valuation. But first, just before we do that, in terms of 80% of the area being unexplored, just have a look on the 20% that was explored, the exploration targets that had been identified. And moving through the level of confidence on this pyramid, you'll see that we start with reconnaissance. There were 15 targets for reconnaissance. 19 targets for phase 1 follow-up, 14 targets for phase 2 follow-up, 8 targets. This is in addition to their reported reserves and resources that we looked at in the earlier module. 8 targets under resource delineation and 5 targets under resource definition. That means they're moving towards resources and reserves that can actually be reported on the stock exchange. And then 6 targets where they were actually designing the reserve and the pit to start production ounces.